Good afternoon, everybody, and welcome to the last panel here of the day, the ETF Industry Roundtable, I guess. My name is Tom Champion. I am in the ETF group at the New York Stock Exchange. I've been working on and with ETFs and with ETF issuers for the past 13 years. I'm very happy, and thank you, Nicholas, for having us moderate this panel. Joining me today is Steve Dunn from Aberdeen Standard Investments, Alex Ashby from Global X, Nick, who's next? Nick Elward from Natixis, and Matt Collins from PGIM. I'll give them each an opportunity to introduce themselves.
Thanks, Tom. So Steve Dunn from Aberdeen Standard. So I've been in the ETF industry since 2000. Started my career with iShares prior to the BlackRock transaction, and sort of grew up through Deutsche and helped launch a number of different products at a lot of different firms. So currently with Aberdeen Standard got into the business recently through an acquisition of ETF securities. And so Aberdeen has been in the ETF business for about a year at this point in time. So thank you. Alex.
Alex Ashby. I manage product development at Global X ETFs. I've been with the firm since 2010. Since then, we've grown to have 70 passively managed ETFs with approximately $10 billion in assets under management. We focus mostly on areas of thematic growth, income, and access solutions.
Hi, my name is Nick Elward. I work at Natixis Investment Managers. I've been working in product roles for about 22 years at different companies. As far as Natixis goes, we're a large asset manager of about $900 billion under management. We're global. We're probably the 15th largest asset manager. You may not have heard of us because our model is one of buying other asset managers and then through central distribution, helping distribute their capabilities. A few of the managers that you may recognize are Loomis Sayles, Harris, or Oakmark. They run funds as well as institutional products. We offer mutual funds, ETFs, and I head up the ETF business. We offer commingled trusts and also private funds. And it's a pleasure to be with you today.
Hi, Matt Collins. I co-head the ETF business for PGIM. If you haven't heard of PGIM, we are the financial asset management arm of Prudential Financial, the insurance company. We have 6 products in the market with about $400 million in assets. We are one of the few ETF managers in the market that are active only. So our sort of strategy in the market is to leverage our existing business and offer active at a relatively low cost. In terms of background, I've spent my entire career in ETFs, started in 2006 with Vanguard, worked with Steve at ETF Securities, and I've been with Prudential for about 2 years now.
All right, thanks, everybody. I don't know how well the audience knows what's going on in the ETF industry, but there was a big announcement yesterday or a couple days ago that Presidian got the approval from the SEC to launch the first non-disclosed or non-transparent actively managed ETFs. It's really big news in our industry. So I think that's how we'll start off. I'm going to ask each of you, what's your firm's reaction to Presidian being approved?
Yeah, and so I'm certainly supportive of the news coming out. Aberdeen has been historically an active shop, and so I think as most of the active shops that are in the mutual fund industry have continued to watch the development from an ETF perspective, and then specifically, what's going on in this space. So certainly I would suggest that we're supportive. Even prior to Aberdeen getting into the ETF business, they were following this process along. So I would assume that Aberdeen is no different than many of the other asset managers in the U.S. and watching this pretty keenly and pretty happy with the developments that are taking place. Obviously now the hard work just begins, but the reality is extremely supportive of the development.
Mm-hmm. Yeah, for Global X's perspective, I'd say we're more of a curious observer. We're purely passively managed ETFs, so we're kind of a few product iterations away from active, non-transparent, but certainly very interesting product innovation. Could give investors more choice. I think there's going to be some interesting questions or see what products come to market, see what kind of the end demand is. It's been challenging to launch new ETFs and get get assets into into new products. So we'll be curious to see how it plays out.
Yeah, really nothing significant to add, but as another active manager, we're very excited about this announcement. Congratulations to Presidian and also to the SEC for all the time they put into this analysis and to get the approval. We are also in line to get approval for active non-transparent ETFs in partnership with the New York Stock Exchange. Natixis has a filing in, and we're awaiting SEC approval and closely collaborating with them to work through the questions that they have. So clearly, we're excited, we're encouraged, and as you mentioned, this is all about choice for investors. And if we can deliver active management that historically was not possible to deliver in an ETF structure, I think that's something that's powerful, and we could see a lot of change in vehicle types for investors, with the ETF structure being one that most recognize as more tax efficient. You have the daily tradability of ETFs that people like, and also some lower operating costs. There's a lot of excitement for people to now have more opportunities to invest in active ETFs. So obviously we're thrilled with this news, Tom.
Right.
Yeah, we're very supportive of Presidian and the sort of non-transparent model. I think with that said, though, I think we'd like to see it opened up quite a bit. I think hopefully, particularly with the ETF rule, the days of a few firms having sort of a hold on a certain type of structure are hopefully over. So we'd like to see multiple models approved, multiple providers out there providing them. I'm sure that'll happen at some point down the road. And then for us personally on the active side, we're pretty comfortable being transparent for most of our portfolios. We feel like that's is a core aspect of ETFs. People do want to know what you hold. But we understand there are strategies that do need to hide their holdings every so often. The higher the active share, the more concentrated your portfolio. You don't want to give away what you buy and sell. So I think we'll be very selective with the kind of strategies that we choose to be non-transparent with. But for the rest of our lineup, we'll try to be as transparent as possible.
And Nick, I'm going to direct this question to you, but you mentioned that Natixis has an exemptive application in with the SEC as well. Natixis has had that application in for a couple of years now. Why did your firm decide early on to file an exemptive relief application? And how do you think that's going to progress? And maybe compare what you're trying to do with what Presidian's trying to do a little bit.
Yeah, sure, Tom. So we're an active manager from the heart on out. So this is something that really ties in well with the firm's philosophy to support active management. Our affiliates are generally high active share equity affiliates, so this is very consistent with that. So that's the start. Additionally, we're already in the ETF business. We have active transparent ETFs, one equity, one fixed income. So you have the experience in that space already. So in terms of how the Presidian model differs from that of the Natixis NYSE model, the Presidian model uses the confidential account approach, which is, it kind of stands out as unique as opposed to the other models that are currently in with the SEC that use more of a proxy portfolio approach. The bottom line is that both styles of the approach are trying to provide market makers a feeling of confidence and understanding how that ETF will behave in the market so they can effectively hedge out their risk of owning or making markets in that ETF. So certainly there are some pros and cons of each approach, but each approach also, based on the data that's been shown to the SEC and data that's been run independently, has a high probability of having tight correlations and being able to generate tight spreads in the market.
So we've been talking about several different approaches here. Presidian, the use of a proxy portfolio that Natixis has filed for. Do you guys think that there's room for more than one approach when it comes to non-transparent, actively managed ETFs? Maybe I'll start with you, Steve.
Yeah, I mean, I echo what Matt's thoughts are. I think the more optionality that there is, The more solutions that there are, the better off there is. You always want competition in this space to provide those. And there's a couple different models out there, and each of them have their own merits from that standpoint. As we're having conversations internally with some of our active managers, there's certain things that they're concerned about. Very similar to what Matt suggested. It's not necessarily the daily transparency. What they're more concerned about is the getting in positions and exiting positions and front running some of those type of aspects. And so, I mean, you want models that have the ability to hide some of that aspect while providing as much transparency as possible. And I think each of the models addresses that way a little bit differently. And so from that standpoint, you want as many folks in there with slightly different options. That just gives us flexibilities as a manager to ultimately decide and what's the best situation for the portfolio. Because we're big fans of the transparency. We're big fans of all the capabilities that the ETFs provide. We'd like to bring some of those same characteristics to the active space. And so the more options you have, the better off you're going to be.
Okay. Alex, your firm currently, I believe, all your products are index-based products. So you're not in the active space, whether it's fully transparent or non-transparent. Again, I think you said you're an active observer. Mm-hmm. In general, and maybe not just on the non-transparent, but in active ETFs altogether, do you see that as one of the future drivers for ETF asset growth?
So, I mean, I think in terms of asset growth, there's definitely potential there. I think the question to me is where those assets going to come from. Certainly you have investors that are already more familiar with, active management, non-transparent, active, and if those investors prefer the ETF structure or wrapper, or it's more cost effective for them to use an actively managed ETF, then I think those assets, could move in that direction. We still, as a passive firm, we're encouraged by a lot of the data that we see around whether it be demographic or generational preferences for, passive. And I think there's a recent survey from Charles Schwab that the preferred vehicle for millennials is 90% of them prefer ETFs as their kind of vehicle of choice. But those investors could develop an interest in active, and I think it's still an open question, but there certainly could be a growth driver there.
Anybody else have anything to add on that?
Yeah, I mean, just on the active side, I think the knock that we hear from the media or our clients is, well, there's a lot of active ETFs out there and they haven't gathered any assets. I think we would argue that there haven't been too many legitimate active managers that are offering what they do well in ETF form. They're offering byproduct of what they don't want to mess with sort of the revenue stream on their traditional active management, and as a result, they launch a passive smart beta fund that sort of looks and feels like their active fund. So no one's really been willing to step forward and offer clients just totally product agnostic offering, where they can choose between the mutual fund and the ETF based off what wrapper works well. So our approach is just to tie in our ETFs directly to the PMs that our clients already know and the same strategy. And I think that's where this non-transparent thing, that'll finally allow some other providers to do the same. And that will be, I think, a huge growth opportunity for the market.
And Tom, I think the way that we're looking at it from a firm standpoint is, as we're having conversations with clients or approaching clients, is you want to have as full of a solution set as possible. So we look at this as a solution in potentially a multi-solution, toolbox, right, kind of aspect. And so it's offering the ability to the end client, how do you want it, we're agnostic to how it's delivered, but we have the capabilities of delivering these in multiple different formats. So from our standpoint, that's the way that we're looking at it, is it's a different vehicle, a different delivery vehicle that we can deliver the solution that ultimately the client is looking for. So whether that's a more transparent, a cost efficient, whatever they're looking for, we'd like to be able to deliver that aspect.
Okay.
Nothing to add to that very comprehensive answer by my three panelists.
Sort of maybe bringing that a little bit further, most of the current ETF investors are doing it to get certain beta exposures. They're all index-based. Do you think most ETFs are index-based? Do you think that it's going to be an easy jump from being invested in index or passive ETFs to the active space for individual investors?
I think If I could, Tom, I think investors will be open to active management like they've historically been. As you look at the assets in active mutual funds, it's tremendous. I think it's roughly 12 trillion in long-term assets under management. So investors are acclimated to using active mutual funds. The jump for them to use active ETFs, I don't think is great. Many are both using active mutual funds and passive mutual funds, or active mutual funds and passive ETFs. So I think just simply the wrapper of active non-transparent ETFs and using active management is not much of a jump. I think they'll be comfortable doing that because, as I said before, they'll look to the tax efficiency, the lower costs, and also the intraday tradability. And those benefits in getting a manager, a premier manager that has proven the active management skill in a mutual fund, is something that will attract them. So I think it's big, and we're looking forward to helping a lot of investors with this new vehicle type.
Anybody else have anything to add on that one? All right, I think, we spoke a lot about active management now. In the ETF space, we have the non-transparent active, which there's no products out there quite yet, and then we have the transparent active. But there's all sorts of other kinds of ETFs out there and new ideas for ETFs coming. Is there trends that you see, and I'll give this question to each of the panelists, do you see trends in product development or different types of ETFs that your firm is interested in listing over the next 3 to 5 years? I know ESG last year, and again now this year, has been a big topic. Are there other trends that you guys are seeing?
Yeah, on our side, we manage about $1 trillion. 700 billion of that is in fixed income, all actively managed. We think there's an enormous opportunity in the active fixed income space. So I think we're going to spend a good amount of our time focusing on actively managed fixed income. As assets continue to move over to ETFs, I think the trend will be a larger market share for active fixed income. So that, I think, for us is where we're going to spend a lot of time.
Now, do you mind if that's, and sorry, just a follow-up question there for you, Matt. In the fixed income space, I think transparency is less of an issue. Would you agree with that?
Yeah, we have absolutely no issue disclosing our holdings, primarily because we do a lot of block orders, a lot of one-on-one transactions with the broker-dealers where scale matters. I think one of the larger issues in the market are with high-yield passive ETFs. That is a space, sort of by definition, non-investment grade, where it doesn't make a ton of sense to just simply buy the market. From our standpoint, it does require fundamental research to understand a company's outlook, our ability to sort of select bonds based off of what we think is a good relative value. But from a trading perspective, it takes time and expertise to buy those bonds and not sort of impact your performance. So just jamming in $400 million a day in a passive fund, I don't think clients realize that's not the best outcome. Typically, there is a cost to that. So we do have an active high yield fund, and the buying and selling is done by us, not by ETF trading firms or market makers. We take cash into the portfolio and we give it to the PMs that are overseeing probably $70 billion in high yield assets. That scale matters. You have better access to new issuance in the market. You can sort of commingle it with other trading activity, and I think that is a good value add for clients.
And I entirely agree with Matt. Fixed income we see as an enormous opportunity as well for ETFs, and also active transparent, not needing to be non-transparent. We have one product in market with Loomis Sales, one of our affiliates now, LSST, and trading really makes a difference. Their expertise, their trading in size, their ability to access IPOs when passive products have difficulty doing that based on reconstitution timelines and rebalancing, all makes a difference. So just adding to fixed income, I think alternatives is another very large growth area for ETFs. There's not much supply out there. Oftentimes clients come to me and say they're just not getting what they need. And we've seen alternatives not be in appeal the last 3-4 years as traditional equities and fixed income have performed so well. But I do think that the next opportunity might be alternative investments in ETFs.
And maybe going back to what you mentioned about ESG, I think it's an interesting case because there is demand out there. The clients are looking for ESG solutions, and products have been coming to market offering those types of approaches, but the assets haven't really followed into the products. And I think part of the challenge with ESG specifically is it's sort of something that means something different to everyone, different issues, different types of approaches, different ways of evaluating and measuring companies. And so I think the challenge with ESG, while we do see it as a growth area, the kind of broader based approaches have a little bit of challenge getting traction because there's a lot of different messages out there. So there are some, I think, interesting opportunities in maybe issue specific ESG products. Certainly institutions, there have been some of the recent launches in the ETF industry that have the most assets, I think, in the past 15 years have been sort of institutionally seeded ESG products. So it's an interesting area, but there have been some challenges matching the supply with the demand for the products.
Yeah, the client base that's been using ESG already has access to a plethora of strategies at a cost that an ETF probably couldn't compete with. I will say, though, we are starting to incorporate ESG metrics into our fundamental credit research, just as a matter of business. Now, obviously, you still have to weigh the investment value and the relative value of the bonds you select, but we are starting just across the board, not just for an ESG type fund, of incorporating those kind of metrics, because we feel like that will have an impact on the business, profitability over the long term, maybe not the short term. So we're starting to incorporate it, but at least from an ETF product perspective, we're just not quite there yet.
Yeah, I mean, I would agree with some of the things that have said. I think in the U.S., fixed income remains an area of opportunity that we continue to look at. And, being a global asset manager like Aberdeen Standard is, one of the benefits that we do is we get to see what's going on in the institutional space, not just here in the U.S., but globally. I would agree with you, Tom, I've been in the ETF space enough where ESG has had its stops and starts, and everyone says next year it's going to happen, and it doesn't happen. Having a look through into the European business from an institutional side, it's real. I mean, there are real assets that are there. I would agree with the folks up here. Maybe the message hasn't been right. Maybe the communication hasn't been right. Maybe the education isn't right. Those types of aspects. But one of the things that Aberdeen Standard does really well is in that ESG space. It literally lines every single strategy that we have, no matter what the strategy is. So there's an ESG element that goes into those products. So from my perspective, it's very real. It's just a matter of, does it translate, and how long does it take to translate? I think the biggest challenge that we've had, and we always spend time thinking about it from a solution standpoint, is where does it fit, right? What does it take the place of? Those types of aspects. Those start to get really. Those are hard questions that you sort of have to figure out. I always look at it from if you're looking at an asset allocation, I'm not looking to add an 11th or a 12th item. I'm looking to replace something that's already in there. And so I don't know that the ESG case I don't know that the case has been made really strong of what it replaces as part of that solution. But I can assure you from an institutional perspective and from an asset standpoint, it absolutely is real.
Do you get to a point where you don't really distinguish an ESG product from a regular product? Like, you just incorporate ESG metrics into everything?
Well, I think that's ultimately what it'll end up being, okay. Right? I think if you buy the case that a company that is well governed that way typically is a company that does well, kind of aspect, right? So it does make sense to incorporate it almost as if another factor in which you're looking at products. So that's the argument that we would typically make, from that standpoint. So I think ultimately what ends up happening is it just gets incorporated rather than perhaps being its own standalone.
Okay.
I would agree, except for maybe cases where someone's looking for a specific impact.
True.
And
yeah.
in
Yeah.
those
Impact
cases, that could remain.
Yeah. We sort of separate impact a little bit from that as well. So.
And impact's actually where we see the most demand. Clients are actively looking for investment opportunities, particularly in real estate. Opportunities with our real estate group, that is in heavy demand, particularly at the financial advisor level. People are looking for that. The ESG level, I think to your point, no one knows when the payoff is. Everyone knows it's the right thing, and companies will be rewarded for doing the right things, but no one knows when the payoff is. So the ideal state is that on the passive side, you just start working those metrics in naturally. It would be nice if some of the index providers, took that step. Every time there's an incident, BlackRock has protests outside, right? Because that they should stop owning gun companies. So you think that at some point there's some talks to just incorporate it naturally into the market, so clients don't have to think about the trade-off themselves.
That's great. Okay, let's move on a little bit here. I think we've got about 12 minutes, so I want to leave about 4 or 5 minutes for question at the end. We talked a lot about active strategies thus far. Most ETFs are passives. Is there still opportunity in passive ETFs?
There's always going to be opportunity. I think the market evolves and there's new opportunities that come about, things that we're talking about today. Perhaps, we weren't talking about, when I originally, as I said, I was originally with iShares, and when iShares started their emerging markets product, the discussion there was capacity was about $1 billion, right? And so obviously markets evolves and things change, from that standpoint. I think all of us collectively that sit up here would suggest it's much harder. It's harder today than what it's ever been in finding those opportunities. Those opportunities do exist. But it's becoming more and more challenging, to find those types of opportunities. And I think you see much more of an angle shifting towards solution-oriented type of things rather than sort of that standalone passive type of aspect. It's just harder. It's just harder to find those pockets.
Yeah, I definitely agree, and I think they do still exist. And part of it is also, you can have a great product and bring it to market, but if you don't have the kind of investor education and support and alignment with the rest of the firm to sort of promote it and make people aware of how to use it in a portfolio, going back to maybe the issues with ESG or some of these products, is what problem are you solving? What solution does this provide that doesn't already exist in the marketplace? So those are getting a little bit more difficult to determine what those are, but there are still certainly opportunities that we see out there.
And for me, we're mostly an actively managed shop, but the way that we do support clients with their passive needs is through separately managed accounts. So some of you have probably become familiar with direct indexing. So instead of buying an ETF that's passively managed, you have an option of buying a separately managed account that replicates the return of a passive universe. And with this, not only do you get the returns of this environment, but you also get better tax efficiency, in that there can be more custom tax loss harvesting to your specific needs, and you can utilize some of those tax benefits to offset gains in other products. So I see that as a nice passive opportunity. In terms of passive in the ETF space, I still like factors. I think factors are a really useful tool for asset allocators, whether it be low vol or value, or everyone knows a litany of other factors, momentum, size. I particularly like low volatility as we look at regime changes and being so late in the current market cycle. If we go through a period of challenges, I think the low volatility products can really stand strong for an investor. So within passive or even active quant, I think low volatility is interesting.
Yeah, I would say scale is as important as it's ever been in the ETF industry. I think everyone up here has felt some form of consolidation from larger companies. To launch a passive ETF these days, you have to lose money for a longer period of time because the price competition is so much. And you have to be part of an asset manager that's willing to take a longer view into the business line. If you don't have that, you're risking buying an index fund from a provider that might not be there. So I think there's opportunity for the passive space. I just don't know that there's that much opportunity for new providers to come into the market on the passive side.
Okay. I guess that sort of leads to another question. Currently, we have about 2,200 ETFs listed in the United States. In 2018, we listed 266 ETFs. So far this year, we've listed at 106. Over the past 2 years, there's been about 200 that have closed. Simple question is, are there too many ETFs?
Well, it's really
It's
tough.
not a simple question.
Right, no, it's not a simple question. But the beauty of it is the market, right? The market's a really powerful thing. The market will determine what it wants and what it doesn't want. That's the beauty of the efficiency of the market. And so, if you launch a product and it's not very well thought through and it's not marketed particularly well, and there's not a distribution plan in place for that, there's a good chance that product is not going to survive. As Matt indicated, it's harder and harder to support smaller products that aren't particularly profitable. But like I said, the market does a really good job of cleaning that aspect out. I think we would all argue that there's probably too many products that exist out there that just aren't supportable moving forward.
Yeah, I would agree. And I think what's interesting, over the past few years is it's become easier to bring products to market, particularly as a new issuer, because the costs of launching an ETF have come down. They are still, it's still an investment, but there are also platforms that allow you to leverage their trust to bring new products to market. But the problem is, as it's become easier to launch new products, it's also become more difficult from a distribution perspective because the due diligence or the home offices and platform providers are having to deal with an influx of new products and have to evaluate and monitor those. So the gates have kind of come up a bit, and so that distribution angle is even more difficult and even more costly. And I think part of that, that liquidation cycle is driven by some of that new challenge.
Yeah, I would say, it's sort of half and half. A lot of the new providers are big, legitimate asset managers. It's American Century, like Mason, Prudential, JP Morgan. But there's also a lot of providers that sort of look to you guys, like Global X, like you had this great thematic ETF. Maybe I could do that. Maybe I could catch a unicorn and gather $1 billion. And unfortunately, not so many of those folks actually achieve that dream because Global X does a really good job of doing those sort of thematic marketplaces. So I would say half of it. I think there's a really long road ahead for the big asset managers, but there are, I think some passive funds that you could just sort of set your timer to when they end up passing away.
Yeah, Tom, it's a good question. We've fortunately been approached by a number of different firms that have talked to us about potentially acquiring and things along those lines. And the classic line that's always used, which is sort of the death knell, is, this product is $1 billion product if it's marketed well. Anyone who's been in the ETF space knows that $1 billion product takes a lot of work, right? They just don't exist.
Or luck.
Oh yeah, or luck. And as Matt indicated, it's a bit of a unicorn out there. Why we all hope to have $1 billion products, it's tough.
And for me, Tom, I see no issues with more ETF development. I agree with Steve's original comment about let the markets decide what works and what doesn't work. Adam Smith, Invisible Hand, I believe in all of that. So I want innovation to continue, and those that succeed will live, and those that don't do well won't. So I think that's fine. Of the 2,200 ETFs that are in market, I think 99% of the assets and probably 92% or so of the actual ETFs are all passive. That means that there's not much in the way of active. So I think that there definitely aren't too many active ETFs, and I would expect to see more, whether they be active transparent or in the future perhaps active non-transparent.
All right, we're running out of time here, so I think we'll end it there. I'll open it up for questions now, if anybody's got any questions. Sorry, I put it right there, and you're right.
Okay. I think it's a great idea for the ETF to go to the alternative space. Yeah. For the past, VC, private equity, private debt has a huge growth, and that's why it creates so much unicorns. I was just wondering how alternative the ETF can go. Thank you.
As a firm, PGIM, which is again the asset manager of Prudential, that is one of our top priorities. Probably not in ETF land. That would be nice, but one of our top priorities, I'll call it retail access, but retail could mean advised or retail direct. One of our top priorities is give them access to more private structures that are typically reserved for our institutional clients. That is a firm priority. It's difficult. You still have to concentrate on certain wirehouses or certain channels and focus your efforts on them. But we're trying to figure that out because that's where a ton of demand is right now, because that is one of the few spaces where you're getting a nice premium over public markets.
Yeah, and I think along those lines, I think Matt and I have even tried to tackle this together. Even if you project out even a little further, as you start to get into some of the real asset spaces, some of those are really hard to solve, at least in current situation. The amount of development that's taken place in the ETF space has been fantastic over the last 5 years. You just need some more developments to take place to get into some of those spaces. I think we all have interest there. It's just really hard to do.
I think we talked about one of these things the other day, yeah. Sorry?
Yeah, with these non-disclosed ETFs, are you still going to have authorized participants, or is everything going to be done in-house? I'm wondering how much of a secret the portfolio could be if it's going out to all these authorized participants. And also, is NAV available routinely the same way as with the type of ETFs we're familiar with?
Yeah, the same ecosystem will still exist. What I would caution is, market makers and trading firms are always willing to price anything. The question is, will the price be fair relative to what the portfolio is worth? And that's where we sort of have to, the market has to, go ahead.
But don't they need to know?
They know, so there's different structures and different opportunities out there, but the holdings will be disclosed in sort of what they call a blind trust. And they'll have access, an independent party will have access to the holdings, so they're able to price it. But the provider is also required to price the portfolio and publish that out to the market. So you would have an idea of what the portfolio is actually worth. They will have an indication of what the actual holdings are, so they can fairly price it. But again, it will not be the same structure you're typically used to buying the S&P 500. There will be a cost, we think.
And with the Presidian model, it is a price that's every second made available, as opposed to currently it's every 15 seconds you get a rough price. But with the other model, the Natixis NYSE model, what the APs would have is a proxy portfolio on which to make their judgments on where they want to price things in terms of the spread.
Anybody else? I can't really see out there.
I think time's
All
up
right.
anyway.
Perfect. Thank you, everybody.
Tom, thank you. Thank you to the panelists for a dynamite last panel. And I think that concludes our 18th annual Closed-End Funds and Global ETFs conference. I think it's been a great day. Thank you very, very much to all of you. Thank you.